Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within Wall Street's filings. And today we have a real spicy one from Coca-Cola Consolidated Incorporated. You might think you know Coca-Cola, but you might not know the intricate dealings of its main bottler. Get ready because we are diving deep into a significant transaction that could rescind the Coca-Cola landscape as we know it. This filling is not just about numbers, it's about strategy power shifts within a beverage giant. Before we jump in, if you like getting these clear actionable insights from complex financial documents, subscribe and ring that bell. Also join our Discord in the description below for more real-time discussions and to connect with fellow corporate sleuths. Alright, so kicking things off, Coca-Cola Consolidated Incorporated, or Coke as you might see on the stock market, has filed a Form 8. This is a current report, meaning something important just happened that the company needs to tell its investors about immediately. Think of it like a breaking news alert from the corporate world. The big news here is about a massive purchase agreement. On the 7th of November 2025, the company entered into a deal to buy back a huge chunk of its own stock. And who are they buying it from? That's right, it's from Carolina Coca-Cola Bottling Investments Incorporated, which is an indirect subsidiary of the global Coca-Cola company itself. This is essentially the Coca-Cola company selling shares of its own bottler back to that bottler. Think of it like trading in your old car for a newer model, but with billions of dollars. The price tag for this repurchase is a cool approximately $2.4 billion. Yes, you heard that right, $2.4 billion is being spent by Coca-Cola Consolidated to buy back its own shares. This is a significant move, and it happened all on the same day, the 7th of November 2025, marking what they call the repurchase closing date. So what does this mean? It means the Coca-Cola company is reducing its stake in its largest independent bottler. This could signal a few things. Maybe they want to give Coke more independence, or perhaps they need the cash for other ventures. Or maybe Coke wants to consolidate control and reduce external influence. This also means the termination of a Stock Rights and Restrictions Agreement, or the SRA, that was in place since 2009. This agreement had rules about who could buy what shares and had provisions for board representation and other important rights. With its termination, the nature of the relationship between the Coca-Cola company and its bottler is clearly changing. Now, buying back $2.4 billion worth of stock isn't something you just do with pocket change. So how did Coca-Cola Consolidated fund this massive repurchase? They used a combination of cash on hand and a significant loan. They tapped into a 364-day senior unsecured bridge term loan facility for $1.2 billion. This is essentially a short-term loan designed to bridge the gap until they can secure more permanent financing or rearrange their capital structure. So a huge chunk of this buyback was funded by debt. They borrowed the full $1.2 billion immediately. This loan will mature in 364 days, which is exactly 1 day shy of a year. The interest on this bridge loan is tied to a benchmark rate called Term SOFR plus an applicable rate. This applicable rate can range from 0.75 to 1.25, 0% based on their credit rating, which is currently set at 1.000% for these loans. This means their borrowing costs are tied to market conditions for short-term loans and their own financial health. The loan comes with strings attached, of course. There are some pretty standard covenants or promises the company must keep. These include limitations on taking on more debt, selling off major assets, or merging with other companies. More importantly, there are two key financial tests they have to meet. They need to maintain a consolidated cash flow to fixed charges ratio of 1.5 to 1.0 or higher. This basically means their operating cash flow needs to be at least 1.5 times their fixed financial obligations, like interest payments and lease payments. They also need to keep their consolidated funded debt to cash flow ratio at 6.0 to 1.0 or lower. This means their total debt should not be more than 6 times their operating cash flow. These are crucial metrics that show how well they can manage their debt. If they fail to meet these covenants, or if other default events happen like bankruptcy or significant legal judgments, the lender Wells Fargo Bank National Association can call in their loan. This means the entire $1.2 billion would become due immediately. This highlights the risk of taking on substantial debt. The bank that provided this loan and its affiliates are also business partners and advisors to Coca-Cola Consolidated, so you often see that overlap in finance. To make sure this repurchase did not trigger any problems with their existing long-term financing, Coca-Cola Consolidated also made some important amendments on the same day. They amended their 5-year unsecured revolving credit facility. The key change here was to adjust the definition of a change in control. This is a common practice when a company buys back a large portion of its shares to ensure that this action itself doesn't count as a negative event or a default under their other loan agreements. Similarly, they amended a couple of their note purchase and private shelf agreements. These are private debt arrangements with entities like MetLife Investment Management LLC and Nile Investors LLC. Again, the primary reason for these amendments was to adjust the definition of change in control so that the $2.4 billion share buyback would not be considered an event of default under these agreements. This shows a careful planning process to manage their entire debt portfolio and avoid unintended consequences from their major transaction. Now, coming back to the termination of the Stock Rights and Restrictions Agreement, or the SRA, this is quite significant. This agreement gave the Coca-Cola Company certain rights like registration rights for their shares and the ability to nominate a person to Coca-Cola Consolidated's board of directors. It also gave Coca-Cola Consolidated some control over the Coca-Cola Company's stock acquisitions and sales. With this termination, the relationship is becoming more purely that of a buyer and seller of products, rather than a closely intertwined shareholder with special rights. As part of these agreements, a director, namely Elaine Bowers-Coventry, resigned from the board on the 7th of November 2025. Her resignation was directly linked to the repurchase and the termination of the SIA importantly. The company states this was not due to any disagreement regarding company operations policies or practices, simply a consequence of the corporate restructuring. To inform the public about these major events, Coca-Cola Consolidated and the Coca-Cola Company jointly issued a news release. This is a standard procedure to ensure transparency and keep investors informed. So what does this all add up to? Coca-Cola Consolidated is spending a massive $2.4 billion to buy back shares from its parent company. This is largely funded by $1.2 billion in new debt through a bridge loan. They have also carefully adjusted their existing loan agreements to prevent this buyback from causing defaults. And the old Stock Rights and Restrictions Agreement is gone. Now, looking at this from a Warren Buffett perspective, though I am not Warren Buffett, this buyback of $2.4 billion is substantial. Repurchasing its own stock can be a good sign if the company believes its shares are undervalued and it can boost earnings per share. However, funding it with $1.2 billion in new debt means they are increasing their financial leverage. This makes them more vulnerable to economic downturns or interest rate hikes. Their ability to service this new debt will be critical. The new financial covenants on their bridge loan are key telltale signs. A cash flow to fixed charges ratio of 1.5 to 1.0 and a debt to cash flow ratio of 6.0 to 1.0 are not overly stringent, but they do require consistent profitable operations. The termination of the SRA is perhaps the most strategically interesting part. It signals a potential move towards greater operational independence for Coca-Cola Consolidated. This could allow them to pursue growth strategies or make other significant decisions without as much direct oversight or partnership entanglement with the Coca-Cola Company. The risk here is if this independence leads to divergent strategies or if Coca-Cola Consolidated struggles to execute effectively on its own. The opportunity lies in Coke potentially becoming a more focused and agile entity. By removing some of the historical ties and obligations, they might be able to unlock new value for shareholders. In conclusion, this filing details a massive financial maneuver that reshapes the ownership and operational relationship between the Coca-Cola Company and its primary bottler Coca-Cola Consolidated. While the buyback and new debt signal aggressive capital allocation, the success hinges on their ability to manage this increased debt load and effectively leverage their newfound independence. What do you think about this massive share buyback? Does it signal a positive future for Coca-Cola Consolidated, or does the increased debt raise red flags for you? Let me know your thoughts in the comments below. If you found this detailed breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into the world of corporate finance. And don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching, see you next time.